Welcome to The Explainer. Okay, today we are digging into a massive paradox in the tech industry that literally has everyone scratching their heads. We're looking past the flashy headlines and really decoding this massive 2026 tech workforce restructuring, specifically from an investor's perspective. Our goal today is to separate the corporate noise from the actual market signal, to understand future business growth, and to identify real investment risk. All right, let's dive into this.
There is exactly one number that basically explains everything we're unpacking today: $725 billion. That is the combined 2026 capital expenditure plan for just 4 companies: Amazon, Google, Meta, and Microsoft. It's a 77% increase from their record spending in 2025. To put that into perspective for you, $725 billion is roughly double the GDP of Norway, and it's 5 times the entire US federal R&D budget. This staggering amount of money is absolutely not going to payroll. It is going straight to data centers, GPUs, and massive power contracts to build out artificial intelligence infrastructure.
So that brings us right to the core mystery we're looking at. If the biggest tech companies on the planet are spending more capital than at literally any point in corporate history, why in the world are they simultaneously executing massive workforce reductions? I mean, why are we seeing headlines about up to 1,000 people losing their jobs every single day?
Section 1. The 2026 Tech Layoff Paradox. The squeeze. The most alarming metric here is the consistency we're seeing across independent layoff trackers. Whether you're looking at layoffs.fyi, SkillSyncer, or TrueUp, the baseline reality is just severe. We are looking at somewhere between 800 and 1,000 tech workers losing their jobs every single day in 2026. And get this, according to Challenger, Gray & Christmas, tech is the exclusive major U.S. industry where layoff announcements are actually higher in 2026 than they were in 2025.
But hey, the raw numbers only tell half the story, right? For the first time in 2 decades, both the exit door and the entry door are slamming shut at the exact same time. On the exit door side, you've got mid-career cuts, like Oracle finishing 30,000 layoffs and Meta letting 8,000 people go. But look at the entry door. Oracle is actively revoking offers from college grads before their first day even starts. Meta quietly erased 6,000 open roles that were never even filled. The classic offer letter? Yeah, it's just no longer a safe contract.
Section 2. Decoding the Reallocation Rhetoric, PR versus reality.
So the corporate vocabulary has completely shifted. Think back to 2023 and 2024. Layoffs then were framed around performance management and, correcting that pandemic-era overhiring. Well, that language is officially retired. Now, in 2026, the explicit framing is all about reallocation and shifting capital to get ready for the Agentic Era. Executives are going out of their way to tell investors, hey, these cuts have absolutely nothing to do with who's actually good at their job.
Just take a look at this quote from Cisco CEO Chuck Robbins about their recent 4,000 job cuts. He explicitly stated it was not a cost-cutting exercise, but rather a cost reallocation. And Cloudflare's CEO said the exact same thing about their 20% headcount reduction. By basically rebranding mass layoffs as this strategic, forward-looking AI infrastructure pivot, companies are trying to reassure their investors. They're saying they aren't shrinking because they're in distress, they're just evolving for the future.
Section 3. Entering the Agentic Era, Rewiring the Workforce.
Okay, you're going to hear the phrase Agentic Era thrown around constantly in earnings calls right now. Take GitLab's Act 2 restructuring as a prime example of what that buzzword actually means on the ground. To prepare for a world built around autonomous AI agents, GitLab isn't just trimming the fat. They are completely rewriting how they operate. They're flattening management from 8 layers down to 5. They're breaking R&D down to 60 much smaller autonomous teams. And they're slashing their global footprint by up to 30%. They're literally stripping out the middle layers to build an ecosystem where AI automates all the reviews, approvals, and handoffs.
So the really crucial takeaway here is how human roles are rapidly evolving inside this new structure. Employees are basically shifting from being makers to being critics who manage and review AI output. For example, Gambling.com reported that AI is already generating 80% of their new code. Let that sink in. Because of this massive leverage, the famous Tech 2 pizza team, it's completely being replaced by the tiny 2-slice team. This is exactly why Amazon AWS is reportedly cutting middle-tier solution architects. Those are the exact oversight roles that agentic AI is designed to absorb. Generalist skills are out, and deep domain expertise is 100% in.
Section 4. Following the AI money, Capex versus Severance.
Now, we've got to follow the money to separate the corporate PR noise from the actual market signal. Like, are these layoffs really funding the AI build-out? Well, when we map up Meta's financial realignment, a massive gap appears. Their additional AI capital expenditure increase for the year is a staggering jump of $43 to $63 billion. But the estimated severance savings from laying off 8,000 employees, that's only about $1.5 to $2 billion. The Capex jump alone is roughly 5 times the total severance bill. The savings from cutting staff are just a drop in the ocean compared to what they're spending on GPUs and data centers.
And this brings us to a really profound realization. These massive layoffs, they are not paying for the $725 billion AI buildout. The math just doesn't work. Instead, these layoffs are a signal to investors. They're declaring which side of the buildout a company is standing on. It's essentially a performative demonstration to the market that a firm is restructuring its identity to be AI first, rather than some meaningful attempt to balance the books.
Section 5. Buybacks and Financial Realities. Finding the Red Flags.
However, as focused investors, we've got to look a little deeper. Notice this recent SEC Form 8K filing from Dow Inc. They announced a transform to outperform strategy, which involves cutting 13% of their workforce. That's about 4,500 roles. Now, while they definitely mention utilizing AI and automation, the hard financial reality buried in the filing is a target of at least $2 billion in additional near-term earnings. Savvy investors use these filings to spot when these so-called strategic transformations are actually just aggressive moves to prop up earnings and improve shareholder returns, especially amidst a 9% year-over-year drop in net sales. We're also seeing a really fascinating paradox when companies pair aggressive share buybacks with workforce reductions. Let's look at GitLab again. They tried to signal strength to the market by authorizing a massive $400 million share repurchase, right alongside launching their forward-looking Act 2 restructuring. But the reality? Despite this buyback cushion, the stock plummeted 36% year-to-date and 50% year-over-year. Analysts remain deeply skeptical about their durability in what is a very saturated market. The AI restructuring buzzwords simply aren't enough to hide structural business concerns from Wall Street.
And the honest truth is, beneath all that strategic transformation branding, many of these layoffs are just reactions to traditional economic pressures. I mean, companies are facing slower enterprise software and consumer spending. Fluctuating U.S. tariff policies are directly hitting advertising revenues at places like Pinterest. Post-merger integrations at companies like Omnicom are causing massive redundancies. Add in geopolitical uncertainty disrupting supply chains, you get the picture. For many companies, pointing the finger at the AI transition is simply a much better PR strategy than admitting they're dealing with weak demand and market volatility.
Section 6. The Investor Bottom Line, Signal versus Noise. Okay, here is your practical decodering to monitor the market going forward. First, track the Q2 capital expenditure guidance from the Big Four: Meta, Amazon, Google, Microsoft. If their combined planned spend crosses $750 billion, expect those structural cuts to accelerate, not stabilize. Second, monitor WARN Act filings in tech-heavy zip codes. Honestly, they're the cleanest leading indicator we have right now. Third, check the Challenger Gray layoff reports. If AI attribution crosses 35% of all cuts, AI is no longer just one cause, it literally is the cycle. Fourth, keep an eye on the NY Fed data on recent college grad underemployment to see if that entry door is structurally gone for good. And finally, always scrutinize those 8K filings to separate genuine AI restructuring from basic legacy cost cutting.
Ultimately, there is one absolutely vital question to ask yourself as you evaluate your own portfolio. When a firm announces a massive reorganization and points to the Agentic Era, look at their capital expenditures, look at their 8K filings, and look at their stock buybacks. Are they truly funding the AI future, or are they just using the shiny buzzwords of 2026 to mask legacy bloat and underlying financial instability? That's the signal you need to find. Keep analyzing, and we'll see you next time on The Explainer.